Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Okay, welcome everyone to the latest Corton Aemelia Quant Fund podcast, where we try to take the emotion out of investing. Before we get started, I'll read the disclosures. I'm Mark Darriott. I'm the founder of Aemelia Capital Management Corp., an independent firm that develops quantitative models that have been licensed to and implemented by Corton Capital. Corton is the investment fund manager and portfolio manager of the Corton Aemelia Quantitative Fund and its underlying fund, Corton Aemelia Quantitative Fund LP, each a related issuer of Corton. This is my mugshot as usual, and we'll get to the presentation. So I'm going to do something a little bit different rather than going through our usual market indicators. A couple of days ago, I gave this presentation to the CMT group, Chartered Market Technicians. So it's people that use a ruler for a living professionally. It's like the CFA, but for technicians. And I thought I'd run through that as part of kind of an educational piece, if you will, or how we look at the world, and focusing on one specific indicator, which is called the RSI, or Relative Strength Index. It was created by this fellow named Wells Wilder, and this is the photo of the book. It simply looks at the average gain versus the average loss over a look back period. In if you look at a weekly chart, it's 14 weeks or 14 days or 14 months as a gauge of the health of a stock or a market. And typically it was interpreted as kind of overbought above 70, you sell it, and oversold below 30 and you buy it. But for our CMT exam, which we completed in I think 2003, this book gave a new twist to that RSI indicator from a woman named Connie Brown. And essentially, rather than selling when things are strong and buying when they're weak, she suggested looking at ranges that this RSI indicator trades in. And so your one idea, it's basically flipped on its head. Embrace strength, and we use a 60 as a signal for strength until it flips to weakness, which is below 40 for us. And this was a real light bulb moment when we read this book over 20 years ago when we were taking this CMT course. So we'll go through some of the stats and some of the charts on a market overview. So it's not just educational, it is giving up-to-date charts. And hopefully it'll shed some light on what we do every day. So it's not the only indicator we look at, but it does backtest fairly well. So what we're looking at specifically, this is for the S&P daily chart. And this RSI indicator is at the bottom. And if we're above 60, which is this red line, we put a green arrow until we fall below 40. And it can give some whipsaws. Here again, it got just briefly above 60. So technically that trigger went on again, and then it went off in spring. And then we did have a deeper sell-off. So it turned off here, and then we had a deeper sell-off, and then it turned back on in early April. It remains on in a bullish regime, they call it, when it's above 60. You can see the recent rallies have not been able to push into that overbought territory. So that's a bit of a yellow light now. I'm kind of hanging out in this neutral zone between 40 and 60 as the market consolidates. So we'd like to see that break out again, but it is technically still on a green light. So hopefully that makes sense to people. Again, simply above 60 is good. until it gets below 40, and then it has to push above 60 again to switch that indicator on. And we back tested this. We combined the Dow and the S&P since 1896, believe it or not, and looked at all the signals. And these are the results for the daily chart. The CAGR is just over 15% when you're in the buy mode, and -8 when you're in a sell mode. The duration is pretty quick, though, just over 2 months for the buys and just under 2 months for the sells. And there have been 372 buys, 371 sells. So that duration is pretty quick. You know, you can't flip your whole portfolio on a dime based on this daily chart, but it is an effective tool. So then we zoom out to weekly data, and the same sort of thing, you know, buy above 60 with its green arrows, sell below 40. And you can see over time, you know, it gets you into the heart of the trade, essentially. We have had many V bottoms, 3 V bottoms, really, since this chart goes back to 2020. That's the COVID low. They're not necessarily the norm. And you can see this indicator would be great at getting you out early into a more drawn out bear market, and then getting you back in with giving the all clear signal, essentially. But if we look at the data, the CAGR here is 10% when you're in a bull mode and -4 roughly when you're in a bear mode. The average returns are here, and the duration is more resilient, if you will. 17 months in a bull trend and 10 months in a bear trend. So that's realistically kind of a trading system for our time frame. And then we looked at the monthly signals. There have been 17 since 1896. These are kind of looking at longer term bull signals, obviously, kind of capturing the secular bull market, if you will. And then we even zoom out to a quarterly chart, but there's only been 5 sell signals since 1920. So you can't really use that as a trading system, but it does kind of indicate maybe when you're going from a secular bull to a secular bear, you can see. So we're going to go through a bunch of charts based and highlighting these RSI signals and, you know, what information we're getting from that for the markets that we track. So these are looking at a summary of currencies, commodities, bonds, and equities. And we have the weekly time frame here and the daily. It's green if it's in this bullish mode where it recently got above 60 and hasn't fallen below 40. And it's red if it's the opposite, below 40 and hasn't been able to push above 60. So we can make some conclusions, and combining these 2 time frames, we see, for instance, in currencies, the US dollar is up, Canadian dollar is down. Bitcoin, you know, it's not necessarily a currency, but I'm not sure where to put it. That's negative. Commodities, you can see, are under pressure on a short-term basis. They're all red. On a weekly basis, gold and silver are red. Bonds, the yields are going up. You can see the 2 and the 10-year are both going up. Credit spreads, interestingly, are going up. They're going up at a modest pace, but that's a bit of a yellow flag for the market. And then equities, generally lots of green there. The exception is the short term for the global equally weighted index, but, you know, in gear in general. And this is the S&P versus the TSX. That's in a downtrend. So we'll fly through some of these charts, but these are simple tables that summarize some of them. So in currencies, as I mentioned, the US dollar recently flipped to a bull trend. That RSI popped its head above 60 for the first time since early 25. Now, no signal is perfect, and you see here lots of whipsaw, unfortunately, on this chart for a couple of years, really, where it looks like it was going to get going, and there was a false start, and so on. So, you know, we don't ever pretend that these signals are perfect, but they do get you on the right side of these very strong periods. You can see when the dollar was in a very strong uptrend, this indicator flipped positive, and when it flipped negative, we then went into this choppy mode. So we don't know if this is the start of another one of these big uptrends, but the signal would say to be long the US dollar. Bitcoin gave a sell signal back in late 25. That remains in place. Commodities. This is a Bloomberg Commodity Index. It's still on a weekly buy signal, kind of held this recent correction. The daily is on a short-term sell. So maybe wait for the daily to get back into gear to get more aggressive in commodity land. Gold recently gave its first sell signal since the buy signal back in the fall of 2023. So that's a very long uptrend that has now been reversed based on this simple indicator. The monthly chart, this is another nuance we look at using this indicator, which wasn't in the book that we read, but just through experience, that when things are running too hot, this RSI is a way to signal that. So this is a monthly chart of gold. And when you get to these extremes, in this case, this is more than 2 deviations over its mean, these 4 circles. That happened in November of last year, a bit early. Gold did keep running, but you can see that was close to the peak. And the last time it happened before that was in, you can see this red circle. And what happened after that? Gold corrected by 22%, and it took 3.5 years before it made a new high. This signal, it took 1.5 years before it made a new high and had a 34% drawdown. So that's another nuance to look at extremes when things are running too hot. So we like to embrace strength, but we get leery when it's too strong. Silver also gave its first sell signal since late 2022 in this case. So you caught that huge run, and these things don't get you out at the top, obviously, but silver was running way too hot back here in January of 26 as well. Copper is still on a buy signal on the weekly, but it's on a sell on the daily, so it's correcting in an uptrend. Oil still, believe it or not, held this line in the sand on the weekly chart, still on a buy. It's a sell on a daily, and that happened several weeks ago. So again, you can combine these signals to tactically trade, and you would have been cautious on oil when it started to falter back here. Bonds, this is zooming way out, and we've shown this chart before. It's quarterly data, not monthly, not weekly, not daily. Every one of these bars is 1 quarter. And we got a buy signal above 60 in the middle of 2022 for the first time since the sell in 1985. So that's one heck of a long downtrend that's been reversed. The weekly chart is on a buy signal. Really, though, the yield has been kind of caught in this choppy range, and we want to see it break out. But the odds are that it's going to push higher, not lower, given the long-term structure. The 2-year yield also flipped positively in the spring, and this has implications for the Fed. You can see the 2-year was in a very strong uptrend until late 23. And if we compare it, as we always do, to the Fed funds, so here the 2-year is in blue, the Fed funds target rate is in red, and the 2-year leads the Fed funds. So the Fed may think it's in control, but it's really the bond market that is dictating the rate structure. And here now, again, it's flipped positively, so we're talking about Fed rate cuts in the news, not surprising. And there have been 8 cutting cycles since the mid-1980s, and 4 of them have resulted in recession, so half, and 4 of them have not. And when you get a recession, the 2-year yield is in red in this chart. Essentially, the demand for capital, it's a reflection of the lack of demand for capital. If you think of the 2-year yield simply as the price of money. So when it falls aggressively, the labor market, you get a recession. This blue line is the prime workforce age employment population ratio. That's a mouthful, but it's essentially people that are aged 25 to 54 in that cohort who have a job. It's 80.7% currently. It's held up very, very well. 2-year yield did fall, but it didn't collapse. And so it looks like we've averted a recession. Turning to credit spread. So this is high yield credit spreads, and that indicator is on a buy signal. So that's a bit of a warning sign. And if we look at the riskiest credit spreads, these are triple Cs, you can see that they are widening a fair amount, much more so than the high yield. And that is potentially a canary in the coal mine for equities, because the bond investors tend to sniff out trouble ahead of equity investors. Equities, speaking of which, this is the global equally weighted index of about 3,000 stocks. It is on a weekly buy signal. That has been the case since the spring of last year. The daily has not yet turned positive, and interestingly, this index hasn't made a new high yet, so it's not confirming the strength in the S&P. This is now a ratio of the world ex-US relative to the S&P, and lo and behold, this is a monthly chart. We have recently, at the beginning of the year, the first buy signal on this monthly RSI since back here. So a long period of underperformance is starting to reverse. And we see the same thing for the TSX index versus the S&P. A big buy signal recently. The sell was in 2011. We had a buy signal in 2000 that lasted a long time. So no one knows if these trends are going to continue, but from a monthly chart perspective, you buy the TSX over the S&P. Here we have sector rotation, the same sort of tables with weekly and daily indicators. Green is good, red is bad, and we'll fly through some of these sectors. So you can see, tech is still the strongest, but some of the other areas are perking up on a daily basis. So tech was the only game in town, and now it's starting to broaden out to other areas. This is a basket of cyclicals relative to defensives, and that is still on a green light. It's still holding support. And these are global sectors relative to the world. So the energy sector gave a sell signal on the daily several weeks ago. The weekly is still actually positive, so it's correcting, but pretty hard, but still technically in an uptrend. So that needs to kind of stick the landing here. That weekly RSI is 43. Below 40 is the level we get concerned about. You can see the last sell signal kept you out of trouble. Materials are also very close to giving a sell. They're at 40 on that weekly indicator. The daily gave a sell several weeks ago. You can see the last sell, these indicators aren't perfect. I'll show you some whipsaw going forward and some other charts, but that kept you out of this whole trouble for the materials sector for 2.5 years or so. Gold stocks just gave a sell after this big run to the upside, so that's in the no-fly zone for us. Industrials, this is an example of whipsaw. You can see lots of signals where it looked like it was getting going, and then it faltered, and then lots of whipsaw. So not all these charts are perfect. There's no panacea. But the weekly is on a sell. The daily just gave a buy, so that area is improving. Tech is still on a buy. It is recently it started to run too hot though. That's why I put a yellow circle there. That RSI got pretty extended. This is discretionary. That's on a sell. Staples are on a sell. Healthcare on a sell on the weekly, but the daily is percolated to a buy. Financials are very close to signaling a buy signal here. The weekly is 58, so remember above 60 is the buy. You can see it tried and failed last time, but it's on the cusp here. REITs are on a sell weekly, but a buy daily, so they're improving. Communications are on a sell. Utes are on a sell. So now we do the same process, but looking at some of our risk measures. So we've got this basket of risk trades called a baker's dozen, and not surprising, there's 13 of them that we show below it across currencies, commodities, credit, and equities. And then we'll talk about some factors. So our baker's dozen is still on a buy signal, so that's good in terms of risk appetite. Not all the signals are firing, so we'll go through some that are good and some that are bad. Emerging market currencies are still okay. Copper to gold recently gave another buy signal, and it gave a couple of whipsaws along the way down, but this thrust up in momentum is stronger than the prior one, so that gives you a bit more confidence that the turn is real. High yield bonds, this is the price of them, so it's not a spread, but just the price of high yield bonds, and that's on a sell signal, and it's something that usually doesn't happen when the S&P is so strong. So if you were to overlay these two charts, the S&P is up here somewhere, and this is down here. Usually off of lows, this chart gives much stronger rally signals, and we're not there yet. That's another kind of yellow light for the markets. This is discretionary versus staples, equally weighted in the US. So things that you want versus things that you need. When the want versus need chart is going down, that's another negative, and that's the case currently. This is semis to software, the kind of topic du jour, if you will, semis in the spotlight. It gave a buy signal back here, and no one knows a priori that we're going to have these huge runs, but this is a way to try to catch these big fish, we call it, right? You look at the momentum indicators, hoping for these outliers and not pretending that you predicted back here. Still on a buy signal, losing some momentum, you can see, and it did get very stretched and not as stretched here. So that's a divergence. The momentum is starting to wane. And if we zoom out to the monthly chart of that ratio of semis to software, indeed, it's in this nosebleed territory where it's very, very high risk. So, these hockey stick patterns can't keep on going forever. So that's a high risk area in our view. Some factors. This is beta, high beta to low vol, still on a buy signal. It's been correcting, but it hasn't broken down yet. Small to large cap is on a buy signal. Value to growth is still on a sell, though it's starting to perk up. So we're on alert. Maybe that chart will flip in favor of value. And then we show our sun range charts based on ETFs. These are industry group ETFs. And we'll just note that a couple of the charts. Firstly, I guess I'll show that the semis and data centers are losing some of their steam in terms of upside momentum. They were in the sunshine, and now they've got down arrows beside them. They're losing some luster, as are things like energy stocks and copper stocks and lots of materials here. Here's the golds, etc. In the rain are still these private equity areas, BISD and PSP. Those are concerns, kind of culprits of a possible bear, this whole private equity theme. Recent members in the sunshine are biotech stocks, IBB, XBI, and then other healthcare. This is pharma, etc. So here's just an example. This is biotech. So gave a buy signal here, big breakout, consolidated, and it's having a nice follow through. This is private equity, PSP. Gave a sell signal back in the spring of last year, and lo and behold, the weakness. We're hearing all about that in the news now. So price usually leads the narrative, we say, and there's no sign of a turn there yet. This is the S&P 100 sun range chart, and we will just go through a few of the charts, most notably Micron. Again, it's a strong stock still. This is one of those big fish you could catch if you follow this discipline. And then the issue is, though, again, on the monthly chart, it's in the nosebleed territory. That monthly RSI recently hit 90. It's got this hockey stick, kind of similar to a hockey stick back here when that momentum indicator got so extreme. So these are, again, high risk environments for these stocks. So that's our take on this RSI indicator. Again, embrace strength above 60 and fear weakness below 40. And it's just one of the indicators that we use when we're looking at charts and trying to assess the risk reward. We tend to focus on weekly indicators. They don't change their minds and give whipsaw like dailies every couple of months. And we are cognizant of these extremes. So running too hot, when this indicator gets above 80 or 90, that's high risk. So again, it was a real light bulb moment for me, literally, which when I read this book about 23 years ago now, believe it or not. We're just going to touch on a few of our indicators and our usual red light, yellow light, green light. Commodities have entered this yellow light territory. They are correcting, still in a bull trend longer term, but the commodity complex has corrected somewhat. There's still a number of green lights, so we're not ultra bearish. But another thing we're watching is the fact that breadth really, it is improving in the US. We have not seen any breadth thrusts, as we call them. The last one was in May of last year. And Canada, the breadth is actually deteriorating quite a bit because of the weakness in the commodity complex. So we're more cautious in Canada than if we were running, say, a US portfolio. So here's the TSX 100, and we're looking for stocks that are coming out of the rain after spending a long time under their umbrellas, if you will, in the lower left. So the only two left really are the E&C companies in the top 100, WSP and Stantec. Thomson has shown a little bit of strength recently. Shopify is improving. These are stocks that were in the rain for quite a while. CSU is up here. It was in the rain for a long time. Waste Connections, the insurance, some more insurance names here, DeFi, Intact, Couche-Tard, etc. So these are the guys that are showing, exhibiting, improving relative strength. In the leaderboard, there's still the banks and so on, but a lot of the banks got really, really stretched. Those RSI indicators fired recently. So our models are feeding the ducks in that area. And you can see the golds and some of the energy names and uranium names. They're still here. They're not fully in the rain yet. Anything can happen. They can reaccelerate. But the tendency is to work your way around this this schematic in a clockwise fashion. So golds were in the sunshine for a long, long time. They're all down here. They're not yet in the rain. So we're quite cautious on the golds. And unfortunately, some of the base metals are starting to follow suit. So we do like base over precious, but the base metal stocks are correcting. So here are just a few examples of stocks that were in the rain for a long time that are changing their stripes. So Couche-Tard, you can see, was in a clear downtrend. We mark this RSI sell signal on a weekly chart relative to the market back here in the spring of 24. And we recently got a buy signal, and we're above this red line that we talk about in our charts. This is a 80-week moving average, or 20 months. So it's all systems go for Couche-Tard relative to the market. Does that mean we're going to have another run up like this? We have no idea, but that's where the potential is. Intact is another one that was in the rain for many, many months, and it's changed its stripes. And then Waste Connections is starting to improve on our sun rain chart. Waste Connections is here. It was hugging the rain for many, many months as well. This explains this big downtrend for about a year and a half. It's starting to reverse. We don't quite see those full green lights with the RSI above 60 or above the red line. We're testing the 200-day, but you can see the momentum is certainly improving, and there's a change of character there. So there's lots of charts that look like this in Canada. Here is our big cap on the left and small to mid cap on the right, our quant screens where our models point in the right direction. And then we mentioned that the breadth in Canada is much weaker than the US. This is one chart we update every day. The green bars show in Canada of a group of about 800 stocks, how many are making new highs, and the red bars are how many making new lows. And the blue line is the spread between the green and the red, and it's a 10-day moving average of the spread to smooth it out a bit. And that flipped negative several weeks ago and remains the case. So simply those red bars are bigger than the green bars. We need that to flip on its head to have a stronger market internals, if you will. The black line is the TSX. And you can see when you're in gear, when the green are bigger than the red, the market tends to do well. And then when the red bars start to expand, the market has a consolidation or a sell-off. And that's where we are now. So we're much more cautious living north of the border than we would be south of the border, frankly. And the issue is resource stocks. So this is a couple of days ago. There were 81 three-month lows, so a big red bar. And you can see lots of golds and lots of materials ex-golds are filling those buckets. On the left show the 3-month highs. So that is our presentation for today. This is the updated performance. Last month was basically flat, down 0.3. We did have a reasonable weighting to copper stocks, which got hit last month. That was one of the big drags on our portfolio. The biggest benefits were actually on the short side of the book, with short oil, short gold stocks, and short Bitcoin, all through ETFs, not individual stocks. So, we're trying to deliver good performance with much lower beta, a much smoother ride, if you will. And, thus far the beta is roughly 0.5, so half the volatility of the market. So we'll leave it at that. This is our contact information. David Jarvis and Corton, they're the IFM and PM of the fund. If interested, please reach out, and we'll talk to you next month. Take care.